Welcome to RPB's 2019 mid-year installment of our quarterly webinar series. I am Stephanie Berger, RPB's Director of Marketing and Communications, and in addition to myself and Len Teitelbaum, Chair of the RPB Board, joining us today is David Baskin, Chair of our Investment Committee and President and Founder of Baskin Wealth Management. Before I turn it over to Len, who will review the agenda and provide some opening remarks, two housekeeping items. A recording of this webinar is available on our website along with the slide deck. And if you have any questions regarding the topics we cover, please feel free to send your questions to askus@rpb.org. Now, Len, the floor is yours.
Thank you, Stephanie. Boker Tov. My name is Leonard Teitelbaum, just as Stephanie had said, and I'm proud to be the current chairman of the board of your RPB. I want to extend greetings to you from your executive director, Michael Kimmel, who's on a well-deserved vacation. Now, while our agenda today is similar to our usual calls in terms of giving you an update on the markets, the economy, and the performance of our plan, investments, and considering the time of the year, camp assignments, and the usual ending of summer routines, we've decided to pre-record this call so that you can punch a hole in your schedule and listen at your leisure. We'd be interested in your opinion, and please, as Stephanie said, contact us. I look forward to speaking with you again live for our third quarter webinar in the fall. I wish you all a very happy end of summer. I'll be talking to you later in this broadcast, and would now like to ask David Baskin to review our recent market activity and plan performance. David?
Thanks very much, Len and Stephanie. And I want to tell everybody that the slides that we're going to be reviewing today were prepared by Stephanie, and I think really tell a great story. So most of you will remember that as we ended 2018, the market was in a very steep downdraft. For the fourth quarter of 2018, most equity markets around the world fell as much as 20%. During 2019, in contrast, we've had a terrific recovery, not only in the United States, but really worldwide. And if you look at the green box that says equity, you can see that stock markets around the world have been up in the second quarter, and in fact, all year. This is in spite of a variety of economic indicators which are mixed. In the United States, employment has been very strong. Unemployment continues to be at post-war lows, but we're seeing weakness in a variety of markets, including important sectors such as housing and automobiles and business investment. Consumer spending remains relatively strong, and consumer confidence remains pretty strong, and that's about 70% of the US economy. However, we are seeing pervasive weakness in foreign markets and foreign economies, and that's a cause of concern. Today, as we speak, the Federal Reserve governors are meeting in New York to decide on interest rate policy, and speculation is almost universal that the Federal Reserve will decide to cut rates in the United States in spite of continuing economic growth and continuing low unemployment. This is unusual to say the least. And one of the reasons for this is that inflation in the United States remains below target. And the fear is that we will see deflation in the United States, which is a real problem that nobody wants to get involved with. In the meantime, stock markets remain strong and bond markets are surprisingly strong as yields fall around the world, perhaps to the surprise of some. Could we go to the next slide, please? You can see that the target rates for short-term money around the world outside of the United States are essentially zero. The European Central Bank basically has cut rates to zero, and as we'll see in a minute, this has resulted in bond yields in Europe being negative. The Bank of Japan has remained in negative territory for a number of years. This means that the Federal Reserve in the United States is an outlier with rates that are far above those in the rest of the world. This has led to a strong US dollar, which is an impediment to US trade because US exports become more expensive for people around the world, and imports to the United States are cheaper. This leads to a US trade imbalance, which the Trump administration opposes. So we certainly expect to see the Federal Reserve lower rates in its meeting that's taking place today, July 30th, and tomorrow, July 31st. Could we see the next slide, please, Stephanie? You can see that the areas in red are places in the world where bonds have a negative yield. And as you can see from this slide, this encompasses almost all of the developed world, certainly almost all of Europe. And this is for maturities going from 6 months out as far as 10 years. This basically means that people in countries such as Germany and Austria and Switzerland are prepared to lend their governments money for 10 years and get nothing in return. In fact, get a negative yield in return. Normally, we see this kind of pattern only in times of deflation, when money becomes worth more as goods become cheaper. This is a real worry. Deflation only happens when there's no growth in the economy, and certainly the central banks would much prefer to see more inflation and higher bond yields. And what we're seeing in the United States is basically those two tensions working against each other. Nonetheless, or perhaps because of these very low yields, stock markets have had a terrific first half of the year. The green line on the very right hand of this graph shows you that the S&P Standard & Poor's 500 is up almost 20% the first half of 2019. That's the best first half in 22 years, and certainly is a surprise to most commentators and is in sharp contrast to the negative results of the second half of 2018. We've seen these wonderful results, particularly in the large growth stocks, but really around the world. And if you look at the next graph, the so-called quilt, which shows you the returns on various asset categories, the 2018 graph shows you that safety was the winning bet. The best performing category in 2018 turned out to be the least risky, stable value, followed by core bonds, which returned zero. Every other asset category in 2018 was negative. But in contrast, in the first part of 2019, we see that equity markets lead the way, with US equities strongly positive and foreign equities close behind. Bonds and high yield bonds and real estate have also done well. And the losing category is that which led last year, stable value, followed by emerging markets and master limited partnerships. So as we say every time that we show the quilt, the importance of the quilt is to emphasize that diversification is the key to a successful portfolio management strategy. Nobody can predict which asset category is going to lead the pack from year to year, and that's why our investment strategy is to diversify across many market categories. Next slide, please. There's no question that we are late in the business cycle. The present expansion in the United States has been underway since early 2009. And by most calculations, it's the longest continuous expansion, that is to say, an expansion not interrupted by a recession, certainly in the last 100 years. Typically, in the late part of a business cycle, you see interest rates rising and inflation rising. But in contrast, and as a great surprise to the economist, what we're seeing now is, in fact, very little inflation, lowering interest rates, but we are seeing moderating growth in corporate profits and somewhat moderating confidence among the consumers. Do we think a recession is imminent? I think the short answer is nobody knows. Certainly federal fiscal policy, that is to say the US federal budget, is highly stimulative, with a $1 trillion operating deficit forecast for the 2019 year. That's an unprecedented level of fiscal stimulus in an expanding economy. And to buttress that with an expansionary monetary policy, that is to say low interest rates, certainly should be enough to either fend off a recession or certainly to moderate any recession that might happen. So if we look at the indicators on this page, the current trend for Fed funds may be falling. We'll find out tomorrow. The yield curve is in fact inverted in some places. That is to say short-term money pays more than long-term money. Economic growth is certainly moderating. Inflation has been falling. Unemployment may now have stabilized. Equities have been rising. So it's a period of contrasting and contrary economic indicators. We don't think that a recession is going to happen in 2019, but it's certainly not out of the question for 2020. Could we go forward one slide, please? So the late cycle doesn't mean the end of the cycle, but it does normally mean that we don't see great performance from the stock market. That may be one reason why the Fed is considering lowering rates, and we certainly may see more volatility. There's a number of factors which lead to increased volatility, including trade tensions between the United States and China, its most important trading partner. Those deals have not been made yet. Those tensions have not yet been satisfied, and that can certainly lead to volatility. Interest rate policy can lead to volatility. And of course, what ultimately drives stock prices are corporate earnings. Right now, we're in the middle of Q2 corporate earnings, which are coming in quite positively so far. When we design our managed products for you, our tier 1 products, our focus is on protecting the downside, protecting your capital. We have designed these products to be less volatile than the market as a whole and to do better in bad times than the market. Should bad times be coming, we'll see how successful we are at that. So that's the economy. Now let's turn to our actual performance. First of all, by looking at our managed products, our tier 1 products, and the actual returns that have been earned in the first 6 months of the year. As always, the returns we're showing you are net of the investment management fees. So our capital appreciation fund, our product that's designed for those prepared to take more risk, has returned 15.9% in the first half of the year. That's an excellent return, very slightly less than the index of world markets, and really an excellent return. The appreciation and income fund, which blends together the more aggressive capital appreciation fund and the income focused, as the name suggests, largely bond weighted fund, 11.9%. That's an excellent return historically for a product of this kind that balances risk and yield, and slightly ahead of its benchmark. The income focused fund itself, 7.1%, a terrific return in a time of low interest rates, significantly ahead of its benchmarks, and we'll talk about why that is in a moment. And finally, the capital preservation fund, the fund which led the way last year in a year of largely negative returns, is not producing much of a return and is more or less matching its benchmark of the US 3-month Treasury bill. So why are these funds performing as they are, and what's inside them if we look under the hood? The Capital Appreciation Fund, focused on growth, is primarily invested in equities around the world, not only US stocks, but developed stocks around the world, markets such as Japan and South Korea and Northern Europe, and also emerging markets. To diversify, we also invest in real assets such as real estate and in US bonds. The Income Focused Fund, as the name suggests, has the object of garnering income on a regular basis regardless of how the markets do. Its core holdings are US bonds and what we call unconstrained fixed income. That is to say, different kinds of bonds, including convertible debt and higher yield bonds. And to diversify that, we put in, again, real assets such as real estate investment trusts and some US stocks which are more income focused. Those diversifiers have allowed the Income Focused Fund to beat its benchmark by a substantial margin this year. The Appreciation Income Fund is simply a blend of these two products, 55% capital appreciation and 45% income focused. And finally, the Capital Preservation Fund, which guards participants' capital in all circumstances by taking out insurance on bonds that are themselves very safe, has a very low return, but very low volatility. And that's, I guess, what participants expect. If we look at the next slide, we can get an idea of the risk that we're taking in these products. As you can see, the Capital Appreciation Fund is significantly less risky than its benchmark against which we measure both performance and risk. Standard deviation demonstrates volatility. A lower standard deviation means the fund is less risky. And you can see as well that our Income Focused Fund is less risky, and therefore our Appreciation and Income Fund is less risky than the benchmark. So what we're trying to achieve in Tier 1 is to get returns which are close to the benchmarks, but with less risk, so that when we do hit negative periods, when we have times when the markets are falling, capital will be more protected in these products. I now want to turn to the Tier 2 investment funds. These are funds which participants have selected for themselves, and these are passive products. That is to say, there is no manager trying to pick stocks or bonds. These are indexed products which will therefore very closely or identically follow the indexes which they're designed to track. And as you can see, that's what products are doing. Those who put their money into the S&P 500 are getting 18.5%, and so forth down the line. I do want to mention the Reform Jewish Values Investment product, which we introduced a while ago. You can see that participants in that product are doing well by doing good. They have a 17.7% return. That's in excess of the benchmark. It's very close to the S&P 500, which is what it's designed to imitate. And just so you'll know, about 1% of total assets under management in the RPB have been invested in the JVI fund, and we'd certainly like to see that grow. So that's the story for the first half. It's a very positive story. We're modestly hopeful going into the second half. Certainly, we expect to see more volatility, and much will depend on how trade talks work out and how earnings come through. And I'm sure that's what the Federal Reserve is talking about in its meetings today. So I'd now like to turn it over to the chairman of the RPB, Leonard Teitelbaum, who will take it from here.
Now, whether you're actively contributing, nearing retirement, or already retired, everyone should log into InfoExpress, our participant portal, to make sure you know which fund you're invested in. Now, how much of your investment portfolio should be invested in stocks, equities, bonds, fixed income product primarily, or cash-based products depends again on your tolerance for risk, how long you have to invest your money, and again, your investment objectives. This will probably come up a little later. Now, while stocks have historically offered the best long-term growth potential, they are more volatile than bonds or cash. The latter are usually considered safer, but have more limited returns. I want to emphasize again, and I will later, I believe, look at our Info Express. I think you'll find a lot of help there, and ones that we would encourage you to use.
Great, thank you, Len. And in Info Express, when you click on My Balance, at the bottom of the screen, which is circled in green, you can see exactly which funds your money is invested in. So now, Len, how should participants allocate their retirement savings, and how is that different for someone who is still working versus someone who is retired?
Sure. I'm going to ask David if he has anything to add to what I'm about to say. Please do. Now, while under legal opinion, we can't tell you how to specifically allocate your investment savings, your retirement savings, we can provide some general rules of thumb, at least in my experience. For those who are beginning or in the middle of your careers, and importantly can tolerate more risk, including growth investments, such as the Tier 1 Capital Appreciation Fund and Tier 2 Equity Asset Class Funds may be more appropriate. If you're more risk adverse, you may want to balance your growth, riskier, and income, relatively safer, investments in your portfolio. The Tier 1 Appreciation Income Fund, or a combination of Tier 2 funds that represent different asset classes, as David outlined earlier, may be more appropriate for you. Now, if you're nearing retirement or are retired, you still need to consider your long-term objectives, as well as your income needs. There's that word again, objective, and risk is implied. Participants in this nearing retirement or retired group usually opt for investment choices that are either balanced between growth and income or more conservative, depending on your risk tolerance. As David has indicated, inflation is low now, but you'll need to make sure your investment returns compensate for the rate of inflation over the long term. This may be of interest to you. Recent study shows that a life expectancy of almost 20 years post-retirement is normal. So no matter what your retirement journey, where you are in your retirement journey, you should, excuse me, you should want to review your objectives periodically. I know this sounds self-explanatory, but people just don't do it. Sit down and seriously think of, are your objectives commensurate with your life goals at the time? Look, things change and time seems to slip away. You hear it from your attorneys on other documents you have. We're suggesting you look at your objectives realistically and informative and regularly. Also, always know what you're invested in. And again, make sure you reevaluate your asset allocation periodically, especially if a major life change occurs. To help in this, again, please go to our website and review the information regarding the funds. There's a treasure trove of information, and thanks to Stephanie and her team, we think it will be incredibly helpful to you, and I hope your investment advisor. Understanding that the U.S., as David has said, is in the late phase of the economic cycle, assess the amount of risk, there's that word again, that you can tolerate now is the same as when you set your objectives earlier. And again, review and make sure you understand what your objectives are for you and your tolerance. And please make sure to check with your investment advisor if you have one, or you can also get some free financial counseling at LifeWorks. Please look at our slides. You'll have that information available to you, and you can, a service that we provide to all plan participants and their family members. Stephanie?
Thank you, Lynn and David, and thank you to everyone who's listening to this quarterly mid-year update. If you have any questions regarding the material we've covered, feel free to email us at askus.org, at askus@rpb.org, and we'll be back to you in the third quarter.
Let me just make a final closing remark. Most of you, I think, have seen faces of our staff at the RPB on the website. And let me suggest to you, I think we have an absolutely first-class executive team, and those who work here and really try and put their efforts into making your life easier deserve your recognition and appreciation. Please look at their faces. They do have personalities. There's not a blank face, but these are top-notch people who have your interest in mind. And we thought I ought to thank them publicly, and I think you should too at your earliest convenience. Thank you.
Thank you.